now if you can see the polls. Are you able to see that on your bar now? Q&A and polls. It should be in between participants, chat, and then it should go Q&A, polls, new share.
No, I've just
Okay.
got the Q&A.
Okay.
Just a normal.
Well, I can go ahead and launch the polls then. I thought it would give us both access equally, but I'm sorry about that.
No, that's totally fine.
Looks like we're people are starting to join. We've got about 3 minutes before the top of the hour, but hello to the early birds. I'm Dan Grenemeyer.
I'm Leah Sky.
We so much appreciate you joining us today. Looks like we're getting a few more people joining. Hi, Amy. Hi, Belinda. Hi, Jeanette. Thanks so much for joining us today. Just got about 2 more minutes and we'll get rolling. It looks like we've got people joining, so thank you so much for joining. Thanks for everybody who's coming in. I still see a few more people joining. Hey, Melanie. Hey, Kim. Thanks for joining. We're gonna try to get going right at the top of the hour at 11 Mountain Time. So we got just a few more minutes.
All right, it's go time. Good morning, and I guess good afternoon to those of our friends joining us from the East Coast. Welcome to our educational webinar series hosted by Altus Receivables Management. Dan and I like to try and do a couple of these per year, and today's webinar is titled Structuring a Solid Credit Policy for the New Economy. So if this is your first time joining a webinar with us, we do encourage you to interact with us throughout the presentation. So send over your questions through the chat feature. You'll see some polls pop up. We'd love your participation in that. But if questions come to you or thoughts, just feel free to type them in. We'd love for this session to really be as collaborative as possible. So we'll, of course, plan to address all questions towards the end of the session as time allows. But just a little overview. Our game plan here is to start with some kind of larger scale macroeconomic trends as it relates to the current economy state, and then filter it down into just some ways that you as a company can mitigate your levels of risk by taking precautions with your internal credit and collection procedures. So I like to start with just a quick bit about who we are. So I know we've got some clients on this call. As some of you may already know, Altus is a very long-standing member of the AR management community. So we work hard. We want to provide our clients with resources, best practices, help you guys keep a firm grip on your B2B recovery processes. We are actually the largest B2B collection firm in North America. Because of that, we've got kind of a bird's eye view of the really severe impact that COVID-19 took on a lot of businesses that were selling on credit terms to retailers, distributors, wholesalers. If you don't know already, my name is Leah Sky, and this is my associate,
Dan Grenemeyer.
He and I have been working really hard for the last couple decades really, as AR specialists assisting companies with credit and collection issues. And it ranges from small businesses, mom and pop, all the way up to some Fortune 100 powerhouses. What we found is honestly, regardless of a company's size, there's always room for improvement when it comes to the order to cash process. So we've had an interesting opportunity to gain some great insight on the situation from where we stand. And we just wanted to share some helpful tips with you guys, our network. Hopefully it allows your team to collect as much money as possible, helps your business thrive, and most importantly, your customer relationships. And then lastly here, just a quick disclaimer. The objective of this webinar is not to sell you on Altus' services. It's really just to give you some tools and suggestions to minimize your losses and maximize the dollars that you're able to put back into your business. So I'm hoping that some of this information will help you find yourself better prepared for global pandemics going forward. Although, knock on wood, I hope this is the last one of our lifetime. But Dan and I are always available. We're just a phone call or email away on a completely free, obligation-free consultative basis, just to help give your AR team a little guidance in the right direction. And we'll, of course, provide our contact information at the end of this webinar so you guys know how to get in touch with us. But without any further delay, I'm going to go ahead and hand it over to Dan, and let's get started.
Yeah, thanks, Leah. So if you think back, if you go back in a time machine 32 months, we never experienced a modern global pandemic before. So I kind of approached it. I felt a little bit out in the water, kind of in uncharted waters, not really knowing. All of a sudden we had trade organizations calling us. We had clients calling us saying, what should we expect? How long is this pandemic going to last? When do you think things are going to go back to normal? And that's really when Leah and I, we did the first webinar we did was over the summer of 2020. And we kind of approached it with this philosophy. I put this quote up there from Bruce Lee, and I just love it from a learning standpoint. And I would just encourage all of you to approach this webinar with this philosophy. Leah and I aren't going to get everything right. You may disagree with some of our opinions on things, and we welcome feedback because we believe peer-to-peer learning and learning together is the best way to move forward by shared experiences. So the quote says, "Absorb what is useful, reject what is useless, and add what is essentially your own." So with that said, I'll kind of jump in and start with some bankruptcy statistics. So the first thing that we started looking at when the pandemic began was we expected to see a massive rise in bankruptcies. I thought with all of the lockdowns and closures that we would see record high bankruptcies in 2020. What we found was actually quite the opposite. 2020 was a 20-year low in bankruptcies. And you can see the number on the far right, the 544,463 marked a 20-year low in bankruptcies. We tried to find other macroeconomic data and kind of tried to compare this to other previous recessions. And the closest that we could come up with was looking at the 2008 recession. So you'll see that double blue line almost to the right. There's a thin blue line with the spike in 2020, but this measured unemployment claims. So immediately after the pandemic and the lockdowns, we saw a record high in unemployment claims, meaning more people were filing for unemployment, either layoffs, furloughs. The companies were closing. And what we expected to follow was a big spike in mortgage delinquencies. So the next thing we looked at was mortgage delinquencies. And even though we saw, I'll show the previous slide again, quite a big difference, 6,000 compared to 25,000 unemployment claims, we didn't see the same amount of mortgage delinquencies. So the red tips are actually foreclosure or the most severe form of delinquency. And you'll see that in the 2020 and the 2021 numbers, we didn't see the same spike. So even though people were losing their jobs or companies were going out of business or were just closing because of the COVID restrictions, we didn't see that translate to mortgage delinquencies and foreclosures. Kind of even more baffling was the next thing that we had happen was the Great Resignation in 2021. You'll see the job openings rate in green and the quits rate in purple. So we had more employees in 2021 that voluntarily left their jobs than ever before in U.S. history. I'll share this slide and I'll just leave it up for a second, but this talks a little bit about why employees were changing their jobs. 28% left without another job lined up, 40% left because of burnout, 37% left because of better compensation. And the two industries that got hit the hardest by the Great Resignation were healthcare, food service, and hospitality. So you've probably been, I know I've been to a restaurant and seen, help wanted signs in almost every restaurant window. A lot of times you'll go into a restaurant and they'll tell you it'll be an hour wait, and you look and you see open tables, and they have the tables, they have the real estate to feed more people and to have more people in their business, but they don't have the servers or the wait staff or the cooks. So that's really impacted businesses. Also, interestingly enough, was we saw more new business applications in 2020 than we had in the 3 years prior. So the slide on the left, or the graph on the left, excuse me, shows new business applications, and you can see that in 2020, and what we think happened is a lot of the people that were furloughed or laid off or let go went out and went on their own and tried to open businesses. Again, on the right side, this kind of summarizes the bankruptcies, and you'll see that 2020 was low. That was the first slide, was a 20-year low, and 2021 was even lower. So we saw even less bankruptcies in 2021. So we'll pause here for just a second and seek some audience participation. So I'm going to throw a poll out here. What is your prediction for the rest of 2021 and the calendar year 2023? So do you think that the economy is going to strengthen? Do you think it'll be flat and it'll be much like 2022? Or do you think it'll weaken the rest of 2022 and into 2023? So everyone should be able to see a poll pop up on their screen, hopefully. If you're able to, I see some votes coming in. It looks like it's about 3/4 are worried about the financial solvency of the existing customers, and about 33%, or a third of the people responding, are worried about evaluating credit risk in new customers. I'll give it a few more minutes. It looks like people are still voting, and then we'll end the poll and I'll actually share the results. So if you haven't answered yet and you'd like to, please do.
Hey, Dan, just a heads up. It looks like you have poll question 2 launched, so you might want to.
I am so sorry. I did launch the wrong poll. So let me just end this, and I'm going to launch the first one again. I apologize for that. Let me do this.
There we go.
There we go. Now, is everybody able to, if everybody can answer the right question, thank you, Leah. The economy will strengthen the rest of 2022 and into 2023. It'll be flat, much like 2022, or it'll weaken in 2022 and 2023. I may have goofed this up, and I don't know if it's allowing people to answer, but I apologize if I messed that up. But go ahead and we'll go ahead and try to jump into the next one. So I'm going to stop sharing this real quick. Sorry about that. We'll know for the future to make sure I launch the right poll question. So one of the things that I kind of asked myself was, why is this the response, as far as we have more employees voluntarily leaving their jobs, we have lower than expected mortgage delinquencies and foreclosures, and the decision that we made was a lot of that, the differences were due to the response. So the government has allocated over $10 trillion, has allocated 13.8 trillion and has dispersed just over 10 trillion. By comparison, that's about 47% of the US GDP. And for me, it's hard to fathom how much 10 trillion truly is, and comprehend the scale and the magnitude of that. So if 13 million were repaid at $1 per minute, it would take about 150 days. If 13 billion were repaid at $1 a minute, it would take 412 years. If 13 trillion with a T were paid at $1 a minute, it would take 412,227 years to pay off $13 trillion. So if that gives you an idea of the scope of how much money went out into the economy, And I'll also say, since it's election day, this was not one party. It started with one president, and the next one continued it. I think that it was done for good reasons. Here's some of the programs and the help that was put out there. There was help for restaurants. There was help for venues that couldn't stay open. There was the Paycheck Protection Program. There's actually a link on the bottom if you're curious how much one of your customers got or somebody that owes you money. And then we had the SBA relief. There was multiple reliefs meant to strengthen the economy. The challenge was, as well intended as those programs were, that influx of cash into the economy has kicked off a pretty rampant amount of inflation. So compared to the few years before, here's a graph showing where we're at with inflation. It has dipped a little bit recently, and I'll talk about why in a few more slides. And then the graph on the right shows which sectors have been most affected by inflation. So food, energy have been affected the most. Energy, gas prices have also trickled over into this next slide, which is the graph on the left shows the cost to ship a 40-foot container from Asia to North America. We obviously all love our iPhones and our Microsoft computers, but we're going to pay more for them because it's costing distributors more, manufacturers more to ship across the ocean. So it's been about a 5-fold increase. Back in the summer of 2020, you would have paid around $5,000 to ship a container, and it got all the way up to $25,000 toward the end of last year. The graph on the right shows the cost of labor for private and for government entities. So you can see that we're spiking, the cost of labor is spiking. So not only is it harder to find employees, but if you do find them, then it's going to cost you more to keep them employed. The next thing that I was going to look at, another factor, is mortgages. So as inflation raises, one of the things that the Fed does to combat that is to raise interest rates, and that'll pull down inflation. The problem with this is that it's costing more to borrow money. It's costing more for not only businesses but for homeowners. So to give you an idea, in January 7th of 2021, if we put a pin in that place in time, for a conventional 30-year mortgage, the interest rate was 2.65%. As of last week, which was the Fed raised the interest rate by 0.75 of a point for the 4th time this year, and interest rates are almost at 7%. They were at 6.95% last week. So if you think about this, that to me, that kind of seems a bit abstract until you think about it in terms of home purchasing power. So if I had perfect timing and I had bought a $500,000 home on January 7th, 2021, my principal and interest would have been $2,015 a month. By comparison, if I went out and put in a new mortgage application today to buy a home, that same home at 7% interest would cost me $3,310. So by comparison, if my budget is fixed and I don't feel like I can afford any more than $2,000, what I would have been able to buy on January 7th, 2021 would have been a $500,000 home. Today, my purchasing power would be down to $305,000. So if you think about that and you translate that to the business world, if businesses are struggling, it's costing them more to get loans. They're paying more in interest, making it harder to climb back out. So in summary, I'll jump to this next slide. In summary, what we've seen over the past 32 months is we saw surprisingly a record low in bankruptcies in 2020. We saw record high unemployment claims, then followed by the Great Resignation, which created staffing difficulties, increased costs of labor. We should continue, and you should continue on your own to closely monitor inflation, interest rates. If you've got credit cards, pay them off, because that's also going to be impacted. And keep in mind, any of the customers that you're selling to, if they're telling you they're getting loans, double check that, because it could cost them, and it probably will cost them more than it has since the 80s to get those loans. And with that, I'm on to poll question 2, which I already launched. So I'm just going to go ahead and share the results of this. So 67% of people said they're worried about the financial solvency of their existing customers. And then 44% said they're worried about evaluating credit risk of new customers. So that's a pretty good segue into Leah's portion of this. As a segue, I'm sharing, my screen shows the bankruptcy numbers from 2018 to 2022. And this goes through June. And Leah will share in a second. We've seen some changes after this since June. And she has a few more recent bankruptcy trends and is going to share some recommendations for the new economy. So Leah, I will pass the talking stick to you.
What a lovely introduction. Thank you so much, Dan. So yeah, taking all of these larger scale trends into account, obviously the pandemic has caused so many of our clients to take an internal look at their in-house credit approval processes because there's no denying that the stakes are just higher these days. Many customers, especially in the retail space, are still feeling residual struggle even now that we're 2.5 years out. Sounds crazy to say that. But the resounding theme of this webinar as a whole is mitigating your risk. So you as a creditor, of course, have to accept a certain level of risk for loss every single time you extend credit, right? It's just the name of the game. But you doing so in a calculated manner allows you to get a pretty good idea of what to expect in terms of loss and also forecast your incoming AR payments. So just how much have things changed in the recent months and how much risk are you as a creditor facing now as opposed to before? So as you can see here, a really useful indicator of financial disruption is always going to be a spike in the number of bankruptcies that are filed. So in a study conducted by the ABI, American Bankruptcy Institute, as of September 2022, it was found that in the US, commercial filings have increased by 16% since last year. And then it should also be noted that individual filings are up 7%. So obviously everyone on this call knows that getting hit with a bankruptcy notice is usually a death sentence to your opportunity to try and collect on a debt. Because normally secured creditors like banks and financial institutions, they're the only ones that get paid, and they're the only ones that have any glimmer of hope to recover post-petition, and even then they get pennies on the dollar. So understanding that the chances of this happening to you are higher now than they've been previously means that you need to take some measures to protect yourself on the front end when it comes to approving who you decide to do business with. So silver lining, typically bankruptcies don't just come out of the blue. There's going to be telltale signs that a bankruptcy is coming. For example, the customer payment patterns might change, or there's a derogatory spike on the customer's credit report. So we'll dive into that and how to be proactive about preparing for that as well. So being proactive really does begin with your onboarding process, because mitigating the risk that you're taking starts before a sale is even finalized. So let that sink in for a moment. It's not actually the steps that you take when you're trying to collect, the common misconception. It's really the steps that you take before that company even becomes a customer, before you even decide to sell to that customer and grant them credit terms. So one of the crucial services that me and Dan have been providing to our clients over the last several years has been credit application consultation. So this means we're diving into the process from day one of the sale request, and we're looking at what information you as a vendor are getting from them before you even approve credit terms. So every single one of my clients, if you talk to them, will tell you that I sound like a broken record, but I always say the same thing. And it's that credit lines are granted and they're not automatic. So in other words, they're earned, they're not just given. I am very against there ever being an automatic net 30 to anyone who walks in the door. That's just a terrible policy, and you're taking unnecessary risk, because you wouldn't just trust a stranger to hold your wallet full of cash, right? Just because your sales rep went out and got a company to agree to carry your product doesn't actually mean that that's going to be a customer that's worthy of getting in on credit. They may very well need to pay in advance, because it's possible that they might not be able to pay you for it. And then if that happens, you're the one responsible for collecting it. So as you can see here, it seems really basic, but you're going to want to start with your company information and demographics. I know it seems so simple, but I cannot tell you how many of my clients have lacked this. And then they place an account for collections with me and I say, where is your signed agreement? Where's your credit application? And they go, damn, the sales rep never got it. And they wish that they had it because it helps with internal efforts, of course, in ensuring that you guys are contacting the right people. You can refer back to it and get some really useful information. And then it also helps us, your third-party partners, with recovery should the sale go awry and we need to step in and intervene. So honestly, what you really want to know is who is this company? How long have they been around? Who's ultimately in charge of approving payments to vendors? That's a big one. Oftentimes I ask my clients and they go, I don't know. I've just got a general AP email. That's unacceptable. You should know who runs the company. You should know who the CFO is. You should know who the controller is, who cuts the checks. What they do in annual sales, obviously, you want to know how big they are. Landlord contact, love this one. It's amazing for leverage. If you could give their landlord a call if you're having trouble getting a hold of them, and you'd be amazed at how fast your phone rings. Now that their landlord knows they're not paying their bills, they're going to make sure you get paid first. But you should also know who else are they buying from, and really important, trade references. So can they provide references showing a history that they make their payments on time? And then we've also got bank. So where are they bank? This is especially helpful if the case does escalate to litigation, because it helps the attorneys that represent you levy a bank account to get you paid if we have to forcefully take those funds. So the next slide here is another very crucial section of a credit application. And what it is it's clearly outlining your credit terms and the stipulations in the event of default. So obviously we don't ever want to think about a brand new customer not paying us, but now is the time to get your securities in order, because you can't just retroactively go back after the account's already in default because they're already dodging your calls. How are you going to get them to fill out a credit application? That's not feasible. You need to get this done in the beginning. So if you have an agreement signed by your customer consenting to pay damages, as you see here, so collection fees, attorney fees, interest, that means if they end up not paying you, and you need to take legal action or collection action. I know it's ugly, but you got to think in those terms. You could potentially have them compensate you for the cost that your company has to go out of pocket to pay an attorney or to pay a collection fee. So I always note that it's not guaranteed that it's going to pan out that way in court. But if you do not have this signed and you don't have a stipulation in your agreement of this nature, it is guaranteed that you will get nothing more than principal, if you even get that, and you're going to have to eat the additional cost. So why not throw it in there just to be on the safe side? And then the second portion here, I would argue is probably the most important, and I hope that everyone on this call is familiar with it, but if not, it's a personal guarantee. And getting this signed means that you can hold a customer signer, so whoever signs the PG, individually liable for paying you in the event of default, even if the business closes down, disconnects their phone number, whatever they do, or files commercial bankruptcy. So normally, as I'm sure a lot of you know, commercial debt is only going to be collectible if the business is solvent. And as we all know, in this climate, that can change overnight. And if you're stuck with a debt against a company that's folded, you've got no recourse. So getting a PG is an amazing idea, especially for new customers, maybe that lack a good credit history, or maybe their credit score indicates that they're higher risk. They've got collection issues, liens, judgments, et cetera. It's an amazing safety net that can very, very often make the difference between collecting or writing off a debt. All right, so lastly, keeping with kind of the pre-sale precautions, I would be remiss not to mention the importance of pairing a solid and signed credit application with the use of credit data to determine a company's financial health. So if you're not already using credit reports, you absolutely should consider starting. Dan and I both recommend Experian or Dun & Bradstreet. Those are honestly the two largest and most reliable and widely used credit bureaus. And the reason is because they have the highest amount of data contributors. Altus also has a portal where you can access both of these and really just get a bigger picture of who this company is that you're about to sell to and take a risk on. So some of the things that are available to you when you buy a credit report are payment trends, as you can see here. So this means how other creditors are reporting this customer's payment patterns. And goes without saying, it's extremely valuable to know if they pay on time before you decide to take a risk and give them your product on terms. And it's usually broken down on both a monthly and a quarterly basis. So you can kind of get a good idea of what to expect from this customer as of how they've been paying recently, because you can see how they've been paying other creditors. So you can kind of get a feel for whether or not they're going to pay within your term deadlines or if they're just going to be a problem right out the gate. All right, so this is the meat of business credit reports. Derogatory remarks. They're legal filings, judgments, and tax liens. And these are all things that a potential customer would never want to share with you, a vendor, voluntarily, but they're imperative for you to know about before you decide whether or not you're going to work with them. So if they have a rocky history with other creditors not being paid and having to take action to secure their interest, it's going to be indicated in this section. You can actually determine their initial credit limit with you accordingly. I wouldn't recommend extending, for example, $50,000 in credit terms to a brand new customer that's got a whole bunch of derogatory remarks, because it's literally just asking for trouble. If they haven't paid other vendors and that's indicated on their credit report, they're not going to pay you. You're not special. So just take that as a cautionary tale and make sure that if you see that they're doing this to other people, that you don't go taking a big risk on them, because they're just going to do the same thing to you. So moving on here to the ugly part of internal credit and collection procedures. There's always going to be recovery challenges. Even if you do everything Dan and I say, take all the necessary steps up front, it's just going to happen. But you're still in control of how you handle it. That's what I always tell my clients. And your level of involvement leading up to and past the due date of the invoice is going to be really important in determining whether or not it's going to be paid. So what I always recommend is having your internal collection team stick to a timeline. I know that it can be really easy to get thrown off based on maybe the customer making empty promises, check is in the mail, or some people just avoid the task in general because it's uncomfortable to have to ask to be paid. I completely understand that's just an awkward position to be in. But furthermore, the Great Resignation is very, very real. And a lot of the AR teams that Dan and I work with are experiencing record levels of turnover. So having a firm policy in place makes it easier when you have to integrate those new team members into the process, and they can just hit the ground running because everything's already in place. So I've got a little quote here. The pandemic reduced the US workforce by 2%. And that actually amounts to about 500,000 people. And that's according to an in-depth study conducted by the National Bureau of Economic Research. So that's a lot of people who have left the workforce, and I'm sure you guys have been feeling it. So as I mentioned, your new hires are going to be a lot more effective in collecting from day one if you have a firm collection policy and a workflow that they can just kind of integrate into and follow. So just telling them to smile and dial all of your past due accounts is lovely in theory, but it's a broken system. There's no organization to it. You can get caught up with distractions, and I just don't recommend it. You really do need to operate a collection effort with intention if you want to have quantifiable results. So starting at day one here, doing a customer touch before the bill is even due is a really good way to ensure that you're keeping your invoice on the front of their mind and also avoiding any quality complaints. It's good to just nip it in the bud. If they were happy with the product and the delivery process and they told you that, and it's going to be less likely that your bill is going to go unpaid. So we recommend doing this probably within about 3 days of the product delivery. Just do a quick QC check. And I really do think that you'll reap the benefits of having a more engaged customer from day one. It also shows them that you care. And then moving on to the due date, you see here, once an invoice falls past due, so maybe say day 30 of net 30 terms, the real work obviously needs to begin. So you should begin with a gentle nudge, I like to call it, of a customer within about 10 days if they're past due. Let them know that you are aware that they're past due. It hasn't fallen off your radar, and you are expecting to be paid shortly. You understand that things happen, but you're just following up to see what the plan is. So I did add some recommended language here for a letter. If you guys want to use that, go right ahead. So the next slide here is going to show you about 10 days after that first notice, that gentle nudge, you should probably be picking up the phone. Always be courteous. Of course, this is still a customer. They've fallen a little behind, but you also need to be direct because they need to know that you're not messing around. So follow up that phone call with a collection letter. And again, recommended template here so you can just kind of get an idea of how to structure that. All right, so by the time you've hit 30 or more days overdue, second phone call should be made and a follow-up collection letter. So let them know you're willing to work with them and just try and get to the bottom of why they're not paying. Is there a cash flow concern? Probably, but honestly, it's better for you to know that early so that alternate payment methods can be set up if necessary. Maybe they need to pay in installments. It would honestly be better for you to figure that out now versus just beginning to have that conversation when they're 90 or 120 days past due and could have already given you 3 or 4 months worth of payments. So by the time they are 60 or more days overdue, things are starting to heat up. The tone of your third phone call and letter should be a lot more serious, noticeably more serious. At this point, you've already given them several opportunities to communicate and resolve it with you directly. And you've confirmed with your QC call right at the beginning that they were happy with the product and they received it. So that "I never got the product" excuse should be out the door. And this is definitely gearing up to be a potential problem on your radar. So you're going to want to politely remind them that your company has to follow a collection protocol. You know, let the protocol be the bad guy. It's not me personally, but I have to follow certain guidelines. And you're nearing the final opportunity to resolve this without it escalating to further consequences. So I also recommend that a final collection notice should follow this call. And at that point is when we're kind of reaching the end here and escalation would be recommended. So that brings me to escalation. So this is a 10-day demand letter. You guys should be familiar with this. If you work in collections, I'm sure you've had to send out your fair share. But the 10 days should go out once a customer hits 90 days past due. And this really, really is important. It should be their true final notice. And you're telling them that you're placing them for collections if they don't pay by X date. You have to be really explicit about the date and you need to follow through on it. Really important to follow through on that threat because I think a lot of my clients get caught up in this part. They continue to give extensions because they, get inbound communication and a promise to pay. And now all of a sudden that 10 days turns into 30, 60, 90, and it falls off your radar. But the clients of mine that firmly follow through with escalating if an account isn't paid by the deadline are the ones who get paid. Go figure. I think honestly, it's because it garners respect from your customers, because it proves that you're not making an idle threat. You have a workflow to follow. They miss their deadline, and you intend on doing what you say. So my last piece here kind of touches on the fluidity of credit limits that you allow and the fact that they should not remain stagnant. I think this is often overlooked. Because this economy has been so volatile, as Dan went over, and bankruptcies are on the rise, now is really the time I think you should be proactive and not take a passive approach to your receivables and your credit policy. So it's something, like I said, often falls by the wayside. The practice of regularly updating your credit limits and your credit applications on file. So we all know that, maybe a company that you approved for, say, $100,000 in credit terms back in 2018 when they were thriving and doing well, that may not be the same company that you're working with today. But have you gone back and reevaluated how much in credit you're giving them? So there's been a record number of closures. As we know, reorganizations are happening left and right. And it's important to ensure that the credit limit that your company is offering now reflects the company that you're currently doing business with, not when they just first approached you. So that always means that you should be revisiting their terms pretty frequently. I recommend quarterly, and just ensure that they still align with that company's current ability to pay and their financial health. So just a couple signs here that you might need to reevaluate credit limits and possibly request a new credit app would be one, a change in ownership. So maybe a new person, you notice a new person is signing the checks that you're receiving, or maybe they sent you a press release to notify you of a name change. If they sold, you need to have an active contract on file which is in the form of your credit application with the current business. So you should certainly send out a new credit application and then kind of run them through the process like they were a brand new customer, because if they sold, they're a new business. Changes in payment behavior patterns, as we touched on earlier, maybe they're slower to remit. They used to pay by 30 days, now they're paying by 60. Just pull an updated credit report and maybe check out their payment trends, see if things might have gone downhill for them recently. You might need to limit your risk if so, and reduce their credit limit so that you're not as exposed should they go out of business, because that's a trend that a company is struggling. So you're going to want to get ahead of it. So we've also got acquisitions and downsizing. This can go both ways. If another company has acquired them, again, you have to get a new credit application. The new entity can't be held to the terms if the application was signed by a different business. So I've seen a lot of my clients, well, oh, I updated the bill to name on the invoice. That's not enough. You need to get a new credit application, because the old one is not enforceable if a different entity signed it, and the new one that acquired them is who you're currently doing business with. But on the upside, it can also be a good thing. Maybe they're growing and you might want to increase their credit limit to allow them to get your product into maybe some new store locations. So it's always good just to stay on top of that and take a look at what's going on. Credit bureau derogatory alerts. So most of my clients who use credit reports through our portal also sign up to receive alerts for when something changes. The report you pulled at the time of the original sale probably looks different a few years down the road. So signs of financial distress indicated on a credit report should require a reevaluation of their credit limit, again, just to mitigate the risk that your company is taking on them. And then lastly here, if you notice an increase in requests for credit references on behalf of that customer, so your phone is constantly ringing, getting requests from your company to vouch for them as a credit reference. It can be a good thing. Maybe they're growing, but it could also mean that they're exhausting their credit resources and they're tapping into a whole bunch of different vendors, maybe vendor hopping, and they're spreading themselves thin. So just be aware of it, keep it on your radar and just know when it's a red flag, because it may be grounds for you to want to reevaluate your credit limit on that particular customer. So I think we've got one more poll question here.
We do, and I'll go ahead and launch this. As you're answering the poll question, please also feel free to ask any questions of us. There should be a Q&A button that you can hit and ask us questions. But our final poll question, we want to know how you're adjusting your credit policies and your risk tolerance. Are you extending more credit? I made it kind of football themed. We're in football season. Are you extending more credit at year end 2022 and into 2023? Are you running a spread offense? Are you not making any changes? You like your game plan, you're going to stick to it? Or are you tightening credit? Are you moving to more of a prevent defense with extra safeties? So I'll give everybody just a minute to answer that. And then we'll read all the poll questions that we can. If for some reason you think of something later, please reach out to Leah or I, and we'll be glad to answer any questions that you have. We actually learn a lot from these by talking to people, answering questions, digging a bit deeper on what people are dealing with, because you're day-to-day in the trenches with us too. So if you have anything, please ask us. Either through the question and answer feature now or later, and I'll share our contact information at the end. But it looks like we're getting pretty good results. I think about 2/3 of the people have answered. So I'll give about 30 seconds. If anybody hasn't answered the poll and you want to, please do. And then we'll jump in and answer some questions. All right, I'm going to go ahead and end it. And then I'm going to share the results. So about 1/3 of people, 3 out of 9 people that responded are going to make no changes. They like their game plan. They're sticking to it. That's good. If you've got a good plan in place, hopefully you learned a few things today that may even help that be a little bit better. And then 2/3, so 6 out of the 9 people say they're tightening credit in 2022 and end of 2022 and into 2023. So thank you for everybody who responded. That's interesting and something for us to take away and think about too. So on to question and answer. It looks like we've got a few questions coming in here. Here's one, Leah. I don't know if you want to take this or you want me to, but it says, how would you handle addressing a debtor that you know received PPP funding while at the same time not paying you? Do you want me to take that or do you want to?
Sure, go ahead.
I mean, I would say it's tough to call them out on it a little bit because they're supposed to use that money for payroll and for mortgage, but you may just want to, it may just be a chance to open up a line of communication and a conversation to say, we know that a lot of money went into your company over the last year. I've got some questions to answer for our leadership about when this can get paid, and maybe it'll open up a line of discussion about a potential payment plan. Maybe they use the money they got from the PPP loan somewhere. And if they don't have a good answer for that, if they just stuffed it in their pocket, I would also look at a few other things. I would look at their credit and see if you're the only one not getting paid, if there are other, other vendors out there not getting paid, or if you're the only one. I'd look at how far they've been past due with you. I kind of recommend the ABCs of credit. So look at the age, look at how long they've owed you for, look at the balance that's due, and then look at their credit risk or their known, trade references, credit reports, and how those trade lines report out on the credit. And then you can make a decision on how to approach it. But yeah, that is tough to know that somebody got a loan while they owed you money and that wasn't enough to get you paid. So I certainly understand that question. It looks
that's always an interesting one.
Looks like we've got the next one says, what is the single biggest thing that you think I can do to protect my business? Do you want to take that one or you want me to, Leah?
The single biggest thing, I'm going to need a minute to think about that one. That's a hard question. I guess maybe due diligence, credit reports.
I'll answer with something I've heard you say before, Leah, and that I remember in a previous webinar we did together, you said not everyone deserves credit, and you kind of gave the audience a chance to respond to that. So I would just say that. I would say don't feel obligated that everybody that knocks on your door deserves credit. If I drive my old truck over to a Ferrari dealership and try to trade it in and get a new Ferrari, they should probably walk me out the door and remind me that I can't afford a Ferrari. And sometimes that's a job of a credit manager or credit analyst, is to say, I'm sorry, but I know you applied for $100,000 in credit. We're going to be much more conservative with this and only give you, $1,000 or $10,000 or whatever you feel is appropriate. So I think to answer that question, the biggest thing you can do is prevent your company from extending credit to somebody who's not deserving of that credit limit, and set an appropriate credit limit for their credit. Maybe the Ferrari dealer could show me a used Honda that they have in the back lot instead of, a new Ferrari. So just those types of things. I think just keeping your company from doing business with people who don't have a good enough credit to pay for it. So that's
absolutely,
that's my answer.
Yeah, just being careful. I've got a question here that kind of goes along with that same sentiment in not everybody deserving credit. And the question is, if a company has been difficult to collect from in the past, how would you recommend we adjust their future credit limit? And I think that this is an excellent question, because if you ask me, you are under no obligation to sell to them on credit terms at all. If they abused it the first time, they didn't earn the privilege and they don't respect your terms. So going forward, they might not deserve credit at all. There's a couple different ways that you can handle it. You can kind of get creative. Some of my clients choose just to part ways altogether with difficult customers. They would rather not have a headache, and I completely understand that. But I also understand that not all businesses have the luxury of turning down sales. So there are some more kind of creative options, as I mentioned, that you can try. Just the good old fashioned cash in advance method. So you can tell them, I'm sorry, your company has lost its credit terms with us, but you're welcome to order and pay COD. And then you could also maybe do like a partial pay in advance. So maybe you could ask for 50% payable up front and do the rest on, a shorter term, maybe net 15, net 30, something like that, just to kind of keep them on a short rein. But just always remember that you as a creditor are under no obligation. You set the rules, you set the boundaries. They don't deserve credit if they didn't earn it. If they don't pay on time and they don't respect your terms, then if they do decide to walk away because they're not happy with what you're offering now, you're not really losing a customer. You're losing a debtor, you're losing a liability, and you're losing probably a migraine. So that's always my recommendation in those situations. You guys hold the keys to the kingdom here. You have the power. So don't deal with anyone that you don't want to deal with.
All right. Well, I think we're coming near the end of our time. There is one more really good question. Amy, thank you for this question. It says, great presentation. Thanks. Will the slides be emailed so we can share them with our team? Yes. What we're going to do, two things. We're going to turn this into a PDF. We're going to turn our slideshow into a PDF and we're going to share that. And then we also recorded this and we're going to turn it into a YouTube video. So we'll try to follow up with everyone. I'm just going to throw our contact information up on the screen. Leah's first and the last name is shorter than mine. So if you want to reach out to her, if that's quicker to write down, but either one of us, if you don't see it within the next couple of days, please reach out and we'll make sure to give you copies of both. This was definitely meant to be something, and I'm so glad to hear that you want to share it with some of your colleagues. So look for us at future events. We're also going to be at Radiance in February. So if that's a larger peer-to-peer learning experience. So if you're interested in that, it's the third week of February. I think it's the 21st and 22nd in Atlanta. And we are a sponsor of that. So it's the largest order to cash, treasury, accounting, collection conference anywhere in the world. And we'd love for you to join as our guest. So if you attended this webinar and want to learn more from other experts and some of your peers that are credit managers, a lot of large Fortune 500 companies like Kellogg, Staples, they're all going to be there, and they share a lot about how they're structuring their credit policies and their collection policies to minimize risk and maximize what they're doing. So I'll just end with that. Feel free to reach out to us, call us, email us, and we'll look forward to talking to you soon. So thank you everyone so much for attending, and we hope you got a lot out of it, and we really appreciate your time today.
Thank you, everyone. Have a great afternoon.
Thanks, everybody.